Welcome to our weekly Ask the Fund Manager series. The premise is simple. We put a fund manager on the spot and we ask them questions about current events and how these events impact on investment markets. We aim to keep it interesting and understandable and do this all in under 5 minutes. We hope you enjoy.
The price of gold has absolutely surged this year. It's up over 50%, and it's on course to have its best year since 1979. So a very, very good year for gold so far. But at the start of this week, we did see a sharp sell-off. And now some investors are wondering, has the rally lost its steam? I'm Luke Burwood, an investment specialist, and today I'm joined by Harriet Ballard, a multi-asset portfolio manager. She's going to break down what's driven the rally so far, why there was a sell-off earlier this week, and what this could mean for investors going forward. Thanks, Harriet, for joining me. I guess the best place to start is, why has gold rallied so much this year?
Thanks, Luke. As you said, gold has surged this year. It's hit an all-time high in price. It's now above $4,000 per ounce, even with the recent pullback. And the big rally has been driven by a couple of different factors. Record central bank buying, especially from developing countries who have been looking to diversify away from US treasuries in dollar. Central banks now account for a record 33% of monthly global demand, which is the highest percentage since records began. And we've also seen strong buying from retail and institutional investors, with gold-backed ETFs seeing a record inflow, $26 billion in the third quarter of 2025. And rate cut expectations, dollar weakening, concerns around fiscal sustainability, they've all fueled demand for gold over the year.
Okay, that all makes sense on why gold's done well. But one thing that I don't really understand, I think some investors don't understand, is that equities have also done really well over the same period. And to me, it seems a bit conflicting. You think of gold, you think it's a defensive asset, more of a safe haven, and then equities is more of a risk-on asset. So why are they moving up in tandem?
Yeah, you're right. Historically, gold and stocks have had little or no correlation, and they've both done well this year. But we have to be careful not to confuse, moving in the same direction with being driven by the same thing. Ultimately, the rally in equities and the rally in gold has been driven by different factors. Equities have performed well this year, given expectations of improved productivity from AI and good earnings, and then more recently a clearer picture around the trade war, while gold has been driven more so by the factors we mentioned earlier.
Okay, thanks for clearing that up. So gold's done well this year. There's reasons behind it, increased demand. But start this week, like I said earlier, sharp sell-off. Why has that happened if we have all these factors increasing demand?
Yeah, I mean, gold dropped 6% in a single day on Tuesday, and that's the biggest daily fall in more than 12 years. But it's come off the back of a very, very strong move in gold, as we've been saying. So, lots of analysts are saying this is just a technical correction after a very frothy run, and it's not necessarily the end of the bull market. Prior to this week's sell-off, the pace of increase over 3 months was 4 standard deviation move. Statistics would say that level of increase over that time period should only happen once in every 126 years.
126 years, fair enough. So given that, I guess maybe not that surprising, there's been a bit of a pullback, but it's definitely one for us to keep an eye on. I think really the big question for investors now is, what does this mean for gold as part of a long-term allocation in portfolios?
Yeah, in the short term, gold is a bit of a crowded position. In fact, in a recent survey from Bank of America, we saw a quarter of fund managers call it the most crowded trade in markets, and that's up from just 12% in August. Even with this week's correction, gold is still trading well above its long-term averages. But the previous drivers that we mentioned at the beginning of this call still remain in place. It can still serve as a safe haven asset and inflation hedge in investors' portfolios. And central banks' gold holdings have risen from 10% to 24% of reserves over the past decade, reflecting a structural shift in demand for reserve management. So while there's volatility in the market, there's still a place for gold in portfolios, and it's just a question of managing the short-term noise.
Thanks, Harriet. That was great as always. So it sounds like despite the short-term volatility, there's still reasons why investors might want to hold gold over the long term. Thanks everyone for watching, or if you're on Spotify, thanks for listening. And join us again next week for another topic that's caught our eye.
Thank you for listening. We hope you enjoyed this episode and we hope you listen in again next week. Also, we love to get feedback and ideas for future episodes. You can use the link provided below to share your thoughts. Before you go, just some important information to be aware of. Unless otherwise stated, any opinions expressed are those of Aviva Investors. You should not be viewing this as an indication of any guarantee of return from an investment managed by Aviva Investors, nor as personal advice of any nature. Information contained herein has been obtained from sources believed to be reliable, but have not been independently verified by Aviva Investors and is not guaranteed to be accurate. Past performance is not a guide to the future. This material is not a recommendation to sell or purchase any investment. The value of any investment and any income from it may go up as well as down, and the investor may not get back the original amount invested. Nothing in this material, including any reference to specific securities, asset classes, and financial markets, is intended to or should be considered as advice or recommendations of any nature.